Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us again for another one of these Beer Money Sundays. Hope you've got yours, whether it's adult beverage or otherwise. Uh, Thank you for being here again. I love doing these informal videos, trying to do them every other week. Haven't been able to do that lately, but we're going to try doing them every other week just to kind of connect with you out there in the community, talk about a topic, and then answer your questions and just kind of talk back and forth, about the markets. And again, I love doing these. It's just a way for me to connect with you more back face to face than our traditional videos. I see a lot of you out there in the Bowtie Nation in the chat. Thank you for being here. John C. from England. Melanie, longtime member of the Bowtie Nation there in the Facebook group and here. Thanks for being here from sunny Seattle. Alco Entertainment, Ulstein from Norway. Love seeing everybody from everywhere out there, across the globe. What we're going to talk about today is timely, obviously, with the Jackson Hole speech by Chair Powell and the Fed about tapering, why it could kind of scare the market and where that's going. We had the speech Friday. As I kind of talked about in the Bowtie Daily last week, I didn't think he was going to give much detail because, the Delta variant gave him an excuse to kind of put it off and kind of put it into that wait and see idea. But obviously, the market is talking about that tapering down from the $120 billion in monthly purchases, as well as the eventual jump in interest rates and how that's going to affect the markets. But what we want to do today is look at how it actually does affect the markets, right? Everybody's screaming stock market crash and what happens when all this liquidity and all this stimulus comes out of the markets and all that kind of thing. But let's look back in history and see what it actually did to the markets, how to play it, and then I'm going to share some ways to invest ahead of that in front of those changes. So, again, thank you for everybody being here. If you're not already a member of the Bowtie Nation and part of the newsletter, I put a link there in the chat for the newsletter. It's a totally free, not daily anymore. We actually did just switch to weekly, so we'll be putting out the first weekly one tonight. But it's a free email newsletter I send out each week. All the news and analysis I'm watching, the stocks that went where they went over the last week, and just kind of how to invest in the market. I was able to keep that free by going to a weekly thing instead of daily. I was spending about 3 to 4 hours a day on the daily newsletter. Couldn't keep that up on a free newsletter, but I didn't want to exclude anybody, by going to a membership or paid model. So kept it totally free. It's there for you every week, waiting for you before the market starts that week to give you some ideas on how to invest. So look for the link there in the sign up. And we're gonna get started here because again, I'm excited to talk about this. It's something that I've been thinking about quite a bit. Obviously, it's one of the biggest preoccupations of the market right now, and it's because the S&P 500 is up 20% already this year. Okay, that's more than twice the 8% long-term annual average. Right, we're only about 9 months through the year. And it's even higher than a lot of the most recent years, right, where we've been enjoying those 10, 12, 15% annual returns on the stock market. So obviously people are, worried that stocks are a little bit expensive. We can look at some of the evidence of that. Here's FactSet Earnings Insight, great resource that I use a lot here on the channel. We can look at here. This is the S&P forward 12-month PE ratio, right? So this is the PE ratio on a forward basis, basically taking the price of all the stocks in the S&P 500 divided by the earnings that analysts are forecasting over the next year. So it's kind of a forward-looking, price of the market. And you only have to look at this. It goes back to 2011 here. You only have to look at it to see that stocks are a little expensive, right? At 21 times forward earnings, that's well above the 10-year average, which is that blue dash line right around 16. The 5-year average is right around 18. So it's very expensive right now. We can actually go up and look at this on a sector level basis as well. And here you see each sector of the S&P 500, right? The sectors of the economy, 11 sectors there. The dark blue line is the forward PE ratio. So that same forward price to earnings ratio. The green line then, or the green bar, is going to be the 10-year average, right? So where that ratio has been over the last 10 years. And understand when you're looking at something like these, even that 10-year average is a little bit higher than normal, than historical, because we've just had such a great 10-year bull market. Really, obviously going back to 2009, so even longer, going on a 12-year bull market, with the exception of the really quick blip we got last year, which technically it was a bear market. Prices fell more than 20% from the peak, stayed there for a little bit, but I don't really consider it a bull market, right, or a bear market, right? A change in that 12-year regime, that bull market, because it took less than a month. It was February 19th through March 23rd when stocks were falling. So that's less than a month, right? Maybe a month, right? The stocks were actually falling, and then the market was back up to where its peak within another 2 or 3 months or 4 months, right? So I don't know that I necessarily consider that a bear market or anything, but that's all semantics. Anyway, but you can't deny that the last 10 years have been very good for stocks. Prices have been higher. So even this green line, this long-term 10-year average, is a little bit higher than maybe where we should consider an average a good point for valuation. But just looking at that, you comparing that dark blue bar with the green bar, obviously everything is expensive. All the way to on the far left here, consumer discretionary, IT stocks, information technology stocks. You've got consumer discretionary trading at about 31 times forward basis. 10-year averages 20 times. So that's about 50% higher than that longer term average. Technology stocks here trading for 26.3 times on a forward basis, over 17 times on the average. So that's about another 50% premium on that. And it's every single sector other than energy. Right here, it looks like energy right now, all the way to the far right, trading for 13.6 times on a forward basis. 10-year average is 15 times. And that's, of course, just because the massive sell-off in energy that we've gotten since 2014, really, but even last year when crude prices went negative. So that's really the only sector right now that's trading below that long-term average on a price-to-earnings basis. You've still got some of these other value sectors, really, right? Financials here next to it, trading at 14 times earnings versus 12.6 times on a long-term basis. So that's less than probably about 10 or 15% premium on there. Healthcare and materials are also a little bit cheaper compared to the other sectors, but still, even those value sectors are still trading above those long-term estimates. So, what we're getting at here is that, yes, the market is expensive on that long-term basis, compared to long-term averages. And we need to understand what's doing that, what's driving that. Is the Fed changing? Is the Fed tapering? Is the Fed, higher interest rates? Is that going to change that? And when might that happen? So if we're talking about what's keeping the market up, it's really just this wave of money that came at the market over the last year. All you have to do is look at a chart. Look at a 5-year chart of the S&P 500, the NASDAQ, any of those big indexes, or most individual stocks, and you see they did well. They did well, all the way up to 2019, 2020, and then when that wave of money that hit from Fed stimulus, from the government stimulus, from low interest rates, when that hit, stocks just went hyperbolic. They went parabolic, right? It went exponential straight up. And that's really what is supporting these kinds of valuations that we're seeing. The Fed alone has pumped something like, it went from 4 to 9, about $5 trillion into the economy. The government, through its stimulus programs, has pumped another $4 or $5 trillion into the economy. And when you're considering a U.S. economy of about $23 trillion, that's basically about 50% growth right there within the span of a year. And, obviously it's something we needed to keep us out of kind of a depression era caused by the pandemic and that kind of thing. But by the Fed, continuing to pump that much pump money into the system, then it's just supporting asset prices, right? It's really not driving employment or driving a lot of this other economic growth. It's just supporting these high asset prices and stock valuations, right? So what we're talking about is the Federal Reserve, the central bank, is buying $120 billion of bonds every single month. They're buying mortgage bonds and they're buying, they're buying treasury bonds, right? And, obviously when the Fed buys bonds, it pays cash for it, right? So it buys these mortgages, it buys treasuries, bonds, right? And it pays cash for those. That cash goes out into the system, into the economy. And, if people really aren't spending it yet, then it goes into investments. It goes into assets and things like that, right? So besides that, they've also kept interest rates for more than a year now down to pretty much zero, right? The Fed sets the reserve interest rate for banks, and that kind of guides all other interest rates above that. So, by keeping its own interest rate, its own Fed funds rate at zero, then all other rates, mortgages, 10-year mortgage is right around 3%, right? Or 30-year mortgage is right around 3% right now, which is, historically low still. By doing that, obviously it makes easy money for corporate borrowers, for households, for everyone out there. Okay, so what we're talking about with the Fed tapering and why the market is talking about this so much is because, once when the Fed stops sending out that $120 billion a month in cash into the economy, after that, it starts raising rates, right? And higher interest rates, higher cost of money means it slows down the economy a little bit. You get less support for the market, and that's really what the market is worried about. So now, what happened is, the Fed, the Chairman Powell, Chair Powell, Friday talked about, yes, we're going to start tapering. We're going to start, spending less or buying fewer bonds each month. So, what they'll do, they're at 120 billion a month right now. They'll maybe go to 20 billion less a month, right? So the first taper, they'll bring it back to only buying 100 billion a month. Then they'll pull it back to 80, 60, 40, and eventually probably sometime mid to late next year, they'll stop buying bonds completely each month. And what the market is worried about again is that after that, then comes rate increases. The Fed's job is to make sure employment stays high, but then to kind of cool down the economy when it gets too high, right? And it does that by increasing interest rates or decreasing them if it wants to spur the economy, or by buying bonds, right? So eventually it's going to have to start raising interest rates to make sure the economy doesn't get too overheated, and inflation doesn't rise too quickly. But what we want to talk about today is, can stocks keep going even when they start, tapering, even when they basically take the punch bowl away from the party? Okay, that's the big analogy that everybody likes to use. The Fed has thrown this party, this liquidity, asset prices, stock market party for the last 2 years. It's pumping so much money into the system. When are they going to take the punch bowl out? When are they going to turn the lights on and say, okay, folks, party's over. You don't have to go home, but you can't stay here. When are they going to start doing that? And how's that going to affect this market party that we've all been having? And, surprisingly, if we look back in history and look at this, then stocks can keep on going. Everybody wants to scream stock market crash when the Fed does, turn on the lights to the party. But the truth is, there's with that 50% of economic growth that's been pushed out into the system over the last year, that can still be able to maintain stocks and maintain the economy for quite some time, actually. So if we actually look at this and look at past evidence, right? So this is a chart of the of the S&P 500, right, in red. Okay, so the S&P 500 is in red here. The NASDAQ is in green, right? So tech-heavy NASDAQ, growth stocks, a little bit more risk-sensitive stocks there. And we'll just make sure you can see this here. Okay, and so I've done 2013. January 2013 is where this starts. End of 2016 is where it ends. And why I picked that date is because that is the last time that the Fed has really, had to come off of this taper kind of thing, right? It was just after the financial crisis. The Fed was buying billions of dollars of bonds each month, rock bottom interest rates. And again, the Fed was looking at an economy that was growing, that was bouncing back, had recovered by 2013, and they were going to start taking away that punch bowl, right? They were going to use the dimmer maybe to turn the lights on to the party instead of just turning them on full force all at once. And so yes, the market expected the Federal Reserve, to start tapering those monthly bond purchases every month. They expected them after that to increase interest rates. And what we saw here in 2013, kind of where we're at now, right? 2021, 2013, kind of the same idea as far as the Fed. They're starting to preview that taper, right? And what you see is, surprisingly, stocks still did very well in 2013. In fact, I think they did something like 13%. S&P 500 rose 13% or no, 25% in 2013 actually. Did very well. You did have a slight scare there early in May. You know, the bonds sold off a lot because obviously if the Fed is buying less bonds, there's less demand for bonds. Interest rates go up quite a bit and went up very quickly in 2013. So that spooked the bond market, spooked the stock market a little bit. So we did have a sell-off here in May through June, right? And we saw about 6% loss on stocks there. Bonds went down very much more. But then, I mean, it rebounded very quickly. Okay, so I don't think you have to worry about this phase of the Fed talking about its taper. And then in 2014, when the Fed actually did start tapering, it actually did start buying fewer bonds in that year, getting ready, obviously, for the eventuality of higher interest rates. And you can see, it still did. Okay, so we were at 25 there. By the end of 2015, we were at 40. So, the S&P 500 still did about 15% that year, even as the Fed is pulling the punch bowl away from the party, even as they are, pushing less money into the system, it still did very well. Now, what I want you to understand here, and while we're looking at this historical evidence, is notice it does become much more volatile. Okay, you had that big sell-off in May of 2013. Then you had two of them in 2014, and some big ones, especially in the NASDAQ here. The NASDAQ with those tech stocks, growth stocks, it's always going to be more volatile than the broader market, the S&P 500. And you saw some really big sell-offs here in 2014 as the market started getting a little bit more worried about the Fed taper, the eventual rise in rates, and that kind of thing. Now, if we go to 2015, but it did rise. Again, it did about 15% in 2014. 2015, finally, the Fed ended its taper, so it stopped buying bonds completely each month, right? And that's what we're expecting the Fed to do probably towards the third quarter of 2022. Okay, the Fed is probably going to stop buying as much as 120 billion bonds a month here in November or December. It's going to scale that back each month that it does that. And then probably around August, maybe August or through October of next year, it's going to stop buying those bonds completely, right? And then eventually, that becomes when do we start increasing rates? And that's what it was doing here in 2015. And you can see this is actually the first year there that stocks did fall. Stocks fell about 5% in 2015. They actually didn't start increasing rates until December of 2015. That was the first interest rate increase, after all this time of worrying about it. And what you see is stocks did, they did okay here in 2015. They had a big sell-off there in August, but it rebounded. And then, late in the year, in November, right into the end of the year, it sold off again and ended up closing 2015 with about a 5% loss. Okay, right? So even that, even all this talk, all this worry about Fed tapering, higher interest rates, after 3 years, after 3 years here, it's still up 40%. Okay, after 2013, 14, and 15, it's still up 40% in those 3 years after all of this talk. And then in 2016, when we had higher rates, right? So the Fed started increasing rates in December 2015, increased them all the way through 2016, and yet we still tacked on about another 14, 15% onto the S&P 500, right? So what I want you to understand here is that as we're looking at this chart, is that the stock market can still keep on going, can still go to higher prices, even as the Fed starts tapering, the Fed starts pulling back that punch bowl and buying fewer bonds, even as the Fed increases interest rates. Data I've shared quite a bit on the channel here that I think as JP Morgan estimates that households have saved over $2 trillion in excess savings over the last year, right? Savings that they wouldn't have otherwise saved up, outside of those stimulus, all the stimulus checks they've been collecting, all the rent, the moratoriums on rents, all that kind of thing have enabled households to save more than $2 trillion in excess, right? That is just that's about 10% of the economy that is ready to be spent, that is pent up demand. Corporations have another roughly about $2 to $3 trillion in cash beyond where they had in 2019. That's on top of what they had in 2019. They've got about another $2 or $3 trillion in excess cash beyond that point that they can now spend on acquisitions. They can buy back stock. They can pay off debt, things like that. So there is a wall of money still out there that is waiting to be spent in the economy. What you do notice though again here is, as we start coming out from from that party of $120 billion monthly, from all the federal stimulus being pushed into the economy, from the low rates, as we start to come out from that, then the market does get more volatile. Okay, we haven't had a 5% pullback in more than a year. I think it was October of 2019, or 2020. I think we had a slight pullback, 5% correction, something like that. We haven't had a 5% correction in the S&P 500 for more than a year, which is extremely rare. Okay, folks. Usually you have at least 5% corrections any given year, and you can see here in this 2013 to 2016 period, we had several pretty big corrections. Here's one, here's two, three, 4, 5. You had 5 or 6 at least in this 3-year period. So as we do start looking into 2022, 23 and beyond, you are going to have more corrections like this, I think, and it's going to be a change to how you need to invest. So let's talk about that. Let's talk about how to invest as the Fed moves into that new regime of pushing less money into the economy, and what you can buy, what kind of sectors, what kind of stocks you can buy. And for this, of course, we got to go to the sector tracker. Another resource I like to use. I use this for our weekly newsletter now, as it were, just to follow those sector ideas, right? And again, these are the 11 stock sectors, the 11 sectors of the economy, the stocks within the S&P 500. If you want to use this yourself, you go to sectorspider.com. That's sector, sectorspdr.com, sectorspider.com. It's the sector tracker there. And you can see how each of these stock sectors has done, the stocks in those sectors has done over the 1 day, 5 days, 1 month, all the way up to, year and 5-year periods, right? Just kind of see how, how the market is positioning in these sectors. And I really like to use this resource as a way to see, trends in the market, what I want to invest in, and really where the inflows are going, where the money is going. Okay. So if we look at this and we kind of think about that idea of, where the Fed is going and where the market is going, what we see is that, what's been working this year is probably going to continue to work because we're now shifting into that environment, right? So if we look at the year to date, we just look at these, and again, I mean, the market is up 20% so far this year, which is well above the long-term average return. And you got some standouts here in those cyclical reflation sectors. Okay, and then when I say that, when I talk about cyclical sectors, those are the sectors, the sectors of the economy, the companies in the economy that tend to do well when the economy is growing, right? Higher manufacturing, industrial growth, things like that. Okay, reflation sectors are very closely related. It's really kind of one and the same because they're pretty much the same sectors. But those reflation sectors, those are the ones that tend to do well on moderate inflation, right? So you've got commodities, you've got the the companies that do well with just a slight little bit of inflation. And these sectors are energy, right, which you can see is the second best. So let's start with financials. Those are the best performing sectors so far this year, 32% return. And financials are going to include, and you can click on any of these and see all the stocks in the S&P 500 in that sector, right? And you can see the percentage changes on them, as well as the index weight. Great resource for kind of getting an idea of what stocks are in each sector and maybe what stocks you want to invest in. But the financials here, those are going to be things like obviously asset brokerages. There's going to be things like banks. There's going to be insurance companies. And the reason why financials do so well in a reflation economy is because interest rates are going to be creeping up. Okay, the 10-year interest rate right now is about 1.35%, which is insanely low for an economy that's growing at 5, 6, 7% a year. Okay, so pretty much the only consensus on Wall Street right now is that interest rates are going to be increasing over the next year. And the financials do very well in that environment. Okay, banks, they make their money by lending short term. They pay you for those deposits, and they pay pretty much nothing right now because short term rates are zero, and they're going to be zero for at least another year and a half. And then they loan out of those longer term rates, right? So as longer term rates keep on going up, banks are going to make more money. Insurance companies, they have to invest all that excess cash, right? All the cash that they collect on premiums, they have to invest that so that they make a profit plus have enough to pay you, when they have to pay those premium or when they have to pay those policies. Well, they're not investing in stocks, really. They're investing in super safe, income bonds, income producing assets. So they have that safety that they know they can pay those policies when they come due, right? So they're paying mostly interest bearing, or they're buying mostly interest bearing investments like bonds, like treasuries, things like that. So again, as those interest rates go up on the bonds, on the treasuries, then insurance companies are doing very well because they're making more money on those premiums that they collect. Things like that. Next here we've got energy has done very well because obviously the oil prices have rebounded from going negative for a moment there last year in April. 30% so far this year, and I think this could continue. Not only because not only on those rebounding energy price, oil prices, and that economic growth, but we're actually seeing a very, very tough hiring condition in the oil sector, right? Or the oil industry. The hiring has become tough across the U.S. and really in a lot of other countries as well. But much more so in the oil sector. What we're seeing is news is out that up to about a third of the people that used to work in oil, before the pandemic, 2019 and before that, have pretty much left and gone to other industries. They got tired of being laid off all the time. They got tired of volatility in the hiring in that industry, and they pretty much left. So it is getting very hard for a lot of these production companies, the services companies, to bring those people back and to hire enough people out there. Well, what that's going to mean? That's going to mean that we probably won't see U.S. energy production, U.S. oil production rebound like we thought it would. Okay, so that's going to mean lower oil production in the U.S. OPEC has only slightly come back online to really satisfying the market demand. So we'll probably see oil prices supported here for quite a while. Oil is at $68 a barrel right now on the WTI West Texas Intermediate oil. I gotta take another drink. And it could go to 70. Just a couple months ago, people were talking about $100 barrel oil. I would like it if it pulled back a little bit to $60 to $65 a barrel to start buying these names again. We added Devon and and NOV to our 2021 Bowtie Nation portfolio about a week ago, and those are already up 15 and 20% just from that bounce back in energy. Oil prices up about 5% in the last week. So I think if oil does fall again down to $60, $65 a barrel, I think that's another great opportunity to get back in these stocks and load up on those. But I do think even at this price, even at these prices, I think over the next year, over the next 2 years, oil companies will do well. I also like consumer discretionary. Hasn't really performed well so far this year, about a 13% return against 20% on the market. But if you look at those that pent up demand in household spending, we really haven't gotten back to that yet. We haven't, with the Delta variant, with the surge in COVID cases over this last month. A lot of these stocks are down over the last month. They've given back a lot. Let's just look at the 1 month. Yeah. So 1 month basis, consumer discretionary. So in that you've got retail stocks, you've got some of your internet retail stuff, but it's mostly the traditional stuff. You've got a lot of the gambling stocks here, apparel stocks, things like that. The only sector that is in the red over the past month, and it's because of the scare over the Delta variant. Well, folks, these variants, while catastrophic, really, this Delta variant has really caused a huge surge. They do have limited lifespans, right? If you look at the different surges in the COVID over the last year and a half, they tend to last a limited amount of time. And if we look at the daily cases, the daily case chart in the COVID at the U.S., we're pretty close to topping out on that. We're probably going to top out on that within the next week, 2 weeks at the most, and then that'll start coming down. People will start getting more optimistic about getting out of their house, going back shopping and things like that. And you're going to see that $2 trillion in excess household savings get spent out into the economy in retailers, restaurants, apparel, different things like that. They're going to keep going to Vegas, and spending at Caesars Entertainment and Penn National Gaming and MGM Resorts, right, that have done really well over the last year or over the last month. But so I think, on that underperformance in the consumer discretionary sector, I think that's also another one to watch, right? And I would look at some of these traditional retailers, some of them that are transitioning into e-commerce and getting a lot of their money from that. I'd look at the higher end retailers. One thing we have seen over the last year is that the pandemic hurt the lower income tranches quite a bit harder, right? A lot of those jobs that people had at the lower income, they weren't something that you could do online or at home, right? So a lot of those, they got furloughed. All they had was unemployment and the extended benefits, things like that. Whereas the higher income areas, obviously those people, they had jobs they could do at home. They had more money in stocks that have gone up over that time. So the higher income, tranches of the economy have actually done very well. They've saved that money. That's where you see a lot of that $2 trillion in excess savings at. Right. So when you're looking at these consumer discretionary stocks, these retail names, things like that, you want to look at the luxury brands. You want to look at things like Tapestry, which owns, I think they own Coach, and they own a lot of those fashion brands, right? You want to look at, other ones, maybe like Under Armour, which sells a little bit more expensive sports and leisure wear. You look at some of the Las Vegas, the gambling companies, Caesars, MGM have all done really well. So I would look at those rather than, obviously, the things like Dollar Tree, Dollar General. Target has done very well over the last year, but you look at some of the other off-brand merchandises and the other off-brand retailers, off-brand apparel, they haven't quite done so well because that segment of the market didn't do quite as well as the luxury brands and apparel. So I would look at those. Things you might want to stay away from over the next year or so as we start talking about this is these safety stocks, the utility companies, the consumer staple stocks that have underperformed the market, and as interest rates increase and pull more people out of those stocks because they're mostly yield bearing or yield sensitive stocks, then those sectors probably won't do as well either. So that's just some ideas to to position yourself in these, as the Fed transitions into, the Fed taper, the higher interest rates eventually, that kind of thing. I want to switch it over to question and answer time now. So I'm going to scroll back up, see what you had on questions. If I don't see your question, please ask it again in the comment section or in the chat window. I'll try to get to it, and we'll see what we got here. What else?